Welcome back to Wilmington Trust's Capital Considerations. I'm your host, Tony Roth, Chief Investment Officer of Wilmington Trust. Today, I'm delighted to be joined by Victoria Gray, founder and principal of Insight Art and Collectibles Advisory. Victoria is a veteran of the global auction world and brings deep expertise in acquisitions, appraisals, and the sale of complex assets, primarily collectibles. Through Insight, she provides independent strategic guidance on all aspects of art and collectibles, partnering with estate attorneys, wealth managers, trustees, and buyers to navigate the complexities of significant collections and legacy collections owned by estates. Prior to launching Insight, Victoria spent more than 2 decades at Bonhams, where she held many roles, including the position of Deputy Chairman of North America. So we're in a world today, Victoria, where there are so many different concerns around traditional assets, around traditional stocks and bonds that range from the core issues around fiscal debt and the amount of debt that the country has and whether or not bond yields will drop, increasing bond values, or whether that won't happen. The stock market is pretty appreciated right now. And we've also had this inflation fight where the value of hard assets like gold, but also like art and other tangibles have assumed a greater prominence in investors' minds as alternatives. And I think that we just came off of a pretty scorching week in New York a couple weeks ago, where the fall auction set some new records in the contemporary and modern spaces, maybe a couple $1 billion or more in some of these auctions. So I think that we're in a period where certainly art as a collectible is probably the leading arena. Maybe we should start the conversation by maybe just giving me your take on where you think the art market is and where it's going, given the context that I laid out, and any additional thoughts that you have, and then we'll go from there.
Yeah, Tony, it's a great question. So the third week in November every year is sort of called Auction Week in New York. And this year, over $2 billion of art traded hands was sold in just 5 days. The past couple years, there'd been a lot of press and a lot of assumptions that the art market was in a downturn, the art market was soft. And the most recent very high watermark in terms of the November sales was the November 2022, when the Paul Allen collection was sold. And the following couple years, 3 years, the seasons were a little bit softer. And, 3 years is an eternity in the art market. But this November, the art market came roaring back in those 5 days. We saw a number of really important estates go up for sale, from the Lauders, the Pritzkers, Elaine Wynn, the Weiss collection, and also the reemergence of trophy lots. So over 16 works of art sold, in a very, very high range above $20 million. And of course, the incredible work, the Klimt painting portrait from the Lauder collection, soared past $200 million, making it the second highest price ever sold for a work of art at auction. So the reemergence of these trophy lots, but also very interesting, we saw the renewed interest and the intense buyer interest in works that were created in the early 20th century, as opposed to the very ultra contemporary works or, the later half of the 20th century. So we saw a lot of works by the Impressionists really command high prices, Rothko, those sort of earlier artists, as opposed to like the Basquiats and the Warhols.
So, Victoria, a lot of this sounds like it's a supply issue. In other words, the top blue chip collectors, they rise to the occasion when the right material is presented, and they are all competing against each other. Some of it perhaps was a broadening of interest. I'm interpreting your last comment, but do you think that this one period of 5 days really represents a reignition of the broad art market, or do you think it's really just the supply that happened to be present and there's not a lot of reason to think it's going to go beyond this?
Well, it's a little bit of both. I mean, it definitely demonstrated that consumer confidence in the art and collectibles market is alive and well and extremely healthy. This is a very buoyant market. But This season also had an abundance of estates with collections that were fresh to the market. The Weiss collection from the Weiss family in Pennsylvania, the supermarket family, no one even really knew that the Weiss family had this collection or it even existed. So these collections that were so fresh to the market, they'd been locked up in private hands for the past 40, 50 years. And then, of course, coupled with, names and the auction house's ability to really tell the stories of the Louders, the Pritzkers, Elaine Wynn and her philanthropy and collecting, creating the narrative around these collections and the fact that they were so fresh to the market really created a feeding frenzy.
And do you think that there's any evidence that these purchasers are in any real way thinking about these assets as part of a diversified, really pool of assets, or are they thinking them more, as you use the word trophy? They either have a love for art or they have some type of ego satisfaction by owning these things. I mean, that plays a very different role where the average investor who's not a multi-billionaire, but maybe worth a lot of money, is going to be a little bit more judicious in how they deploy their funds in terms of anything of that large number is going to really need to have an investment return that's going to persist for them, as opposed to these hyper multi-billionaires are going to just buy anything without even thinking about it, perhaps. I mean, how do you think about the sensibility of the broader marketplace as an investment versus it truly being a collectible? And maybe this is a good moment to broaden the conversation, because I think there's a question, as I started the conversation initially, around traditional investable liquid securities and whether or not and to what degree collectibles could play a diversifier from an investing standpoint. How do you think about those issues when you're asked by collectors whether they be focused on art, or everything's different, of course, but it could be wine or coins or cars, etc.?
Yeah, it's a great question. I mean, there is no doubt that there were a lot of people looking to capitalize on good investments, especially over the past couple of years when it's been such a buyer's market, when, certain areas have been a little bit softer. But I think in the November sales, people were definitely being opportunistic, looking to invest in very blue chip artists that would hold value over the next few decades. You mentioned something like wine and the greater collectibles market. Wine traditionally has been a much more fixed commodity. Wine, we take a spreadsheet and it's a pretty set formula in terms of what bottles are trading hands for. It doesn't change that much. We can price out a spreadsheet of a seller very quickly just based on the comps. And there are so many wine auctions and online sales out there. The market for fine art, especially this very high-end 20th and 21st century, there are really only 2 weeks in the year where the market at this level changes hands. That's May and November. So there's much more consistent pricing in wine than there is in the fine art market. But I think in terms of collectibles, in the past few years, we have seen an extraordinary surge in the luxury collectibles market. So purses, belts, shoes, couture, the whole sort of fashion and luxury industry has absolutely exploded.
What do you attribute that to? In other words, I could see it being either a way for less wealthy non-billionaires, not that billionaires wouldn't participate potentially, but maybe the non-billionaires to have those ego satisfaction or trophy assets for them, because they're not going to buy $200 million Klimt painting. Or it could be that they genuinely believe that, hey, if I buy a bunch of Hermes handbags for 50 grand a pop, I'll be able to sell them in 3 years for 100 grand a pop. And maybe they're making an investment statement.
Yeah, I think it's two things. One is we have seen sort of Gen X, Gen Z, millennials really enter the market in a strong way over the past couple of years. And they are not buying what the baby boomers were buying, right? I mean, the things that we're seeing them buy versus what's coming to the market in the great wealth transfer couldn't be more different. So they're looking for watches, belts, purses, like an Hermes handbag, like you said. The influx of those generations into the marketplace, but also the huge shift of the traditional auction market from live auctions to online auctions.
Right.
And of course, COVID was a forcing function for this. But even for live auctions, we see on average, over 65% of lots, even in live auctions, are sold to an online bidder, online buyer. So these timed online auctions that are open for sort of 8 or 10 days, they've made the auction market much more accessible to people. Whereas, previously people might have been intimidated to bid under pressure, under duress with an auctioneer about to drop the hammer. This way they have 8, 10 days to think about it. They can place a bid in the comfort of their own home. They can think about it again, place another bid, whereas they're not buying under pressure. Whereas, in the traditional live auction format, that's how it was.
And do you find that buyers in the non-blue chip A pieces, top of the market, are deploying meaningful amounts of their wealth, 5% or more, into these kinds of assets? Or is it rather that they have more money they can spend, and so they're going to dabble in wherever their interest might lie? Yes, in today's world, some of those luxury categories are rising, probably, and ironically, given what we talked about 2 weeks ago, some of the art categories are probably dropping outside of the apogee of that art pyramid. And I'm trying to get at this question of whether people are really doing this because they're trying to make an investment and they're being thoughtful about building a diverse asset pool, or is it really just sort of play money on the side? It's not a large portion. And that's what I would have thought it was in most cases, but I don't know.
Yeah, so we see sort of the individual buyer, the individual collector. For them, it's more of a passion project. The history of connoisseurship, and they get the collecting bug in one certain area. Is it, rare books or coins or some of those more traditional collectible categories? But then we see a lot of family offices and other very high net worth individuals that are absolutely going at it from an investment standpoint. So we've seen a lot of family offices get extremely active in the collector's car market, in the wine market, in the coin market, but in gold coins specifically. It used to be that the diamond market was a great place. Everyone was at some point saying rocks, not stocks, and put your money into hard assets like diamonds. The influx of lab grown diamonds into the diamond market has absolutely torpedoed the value of diamonds and how they're valued and how you price it. And it has become very tricky. About 45% of diamond engagement rings last year were lab grown diamonds. So historically, people have bought the diamonds they could afford at that time. Maybe 10, 15, 20 years from now, you might get sort of an upgrade ring or a larger stone. Not anymore. They go in for the really large stone right up front. And if they can't afford it, they go for the lab grown stone. So that's an area that people used to look as a really great investment, diamonds, but we're not seeing that anymore. That is more for personal use.
Okay, so let's be systematic, if we could, about this. And you've already covered diamonds. Let's go back to art, and then let's go through some of these other categories and talk about what your outlook would be. Understanding, of course, these are not heterogeneous categories. Art is extremely diverse. So take art. If you're interested in art, you're not going to be buying a picture for $50 million, even $20 million. You're going to be buying lots in the hundreds of thousands to low millions, let's just say. It could be by blue chip artists, but obviously they're not the pictures that are going to end up hanging in the foyer of the MoMA. How do you see that market evolving, and what areas do you think are going to be potentially the areas to do well in the next decade, and what are the areas that may do less well? Old masters or some of these things that you would think would be of less interest to those younger generations that you mentioned.
If we just look at the painting market, for example, within the broader fine art category, female artists, definitely we are seeing a huge surge in the value of works by female artists. 3 weeks ago, that great example by Frida Kahlo, which was now the highest price paid for a painting by a female artist, which surpassed the Georgia Keefe, which had the market. But yes, absolutely. Living female artists that are not living, a huge interest. We are also seeing foundations and private foundations just focusing on works by female artists. There's a foundation, Silicon Valley couple and they have a foundation, the Shaw Guard Foundation, and their foundation is just investing in works by female artists. The foundation currently has a national tour of the works in the collection. The national exhibit is called Making Her Mark, and it's all about female artists, and especially female artists of color. So we're definitely seeing a huge interest and a surge in that market. Another area within, just staying within the fine art category, is photography. Huge amount of interest in the photography market. And a lot of that is because of the younger generation coming into the market. And they might not be able to buy an original Damien Hirst, but they could buy a Damien Hirst print. So it allows them access to one of these very blue chip artists and a work by these artists, but at a lesser price point.
And what about buying works, whether they be a multiple or an original work, but a much lower price point of some of the blue chip artists that are doing so well at the big auctions, whether they're alive or not? What are your thoughts there?
Yes, 100%. Buying prints and multiples by these very blue chip artists is definitely a great investment. Markets are going up for those continually, year on year, season on season. There's a huge interest in prints. Prints are accessible. They're easier for people in terms of storage, insurance, managing the collection. The one thing to really keep in mind that affects the value with the prints and multiples market is condition. So the print buyers are historically purists, and it's on a sheet of paper. So that's important to keep in mind, that it's in great condition.
I personally have been a print collector, a photography collector for a long time, and I've always felt that it's too bad I didn't take everything I ever spent on art and saved it for one piece. But we'll have to wait and see over time whether or not some of these pieces will in fact pay off for me. Although I did all this because I love the work. So what areas would you say are less in favor from a fine arts collectible standpoint right now? Where would you suggest that collectors maybe veer away from?
Yeah, I mean, obviously, over the past couple of years, the furniture market, and not 20th century design, but 18th and 19th century furniture, what we sort of lovingly refer to as brown furniture. The brown furniture, sort of what you would have in your grandparents' house with the traditional Persian carpets and, silver, crystal, anything that sort of from that genre, where people used to have a big armoire to store the crystal, the china, the silver, carpets and rugs, brown furniture. It continues to still be really challenging to command prices or even find sale venues for those sorts of things. First of all, it's because there's a huge supply hitting the market. Second of all, it's a little bit out of style, out of favor. Everybody's going for the Formica tables that were made in the 60s. But also, it's just lifestyles have changed. So people are not doing the same sort of formal entertaining in the same way that they were.
That is fine arts. Just a word, because we do have quite a few clients who have inherited old master paintings. I'm assuming that that's probably not a great investment on a go-forward basis, that genre, that's kind of 19th century, call it darker boats or static still lives, even with figures. Those kinds of paintings are probably not, unless they're really blue chip, probably not going to command a lot of money these days, relatively speaking.
Yes, the 19th century European paintings, pastoral landscapes and things, the market is extremely soft for those. You have to sort of sprinkle one or two in maybe an estate or interiors auction to try and get those away. But yeah, they're not popular at all. I wouldn't put old masters in the same category as 19th century European
Right.
paintings. Old masters are performing much better. The market for those is really in London and in Europe, so they're not sold in New York. But the auction houses have all pretty much closed their 19th century European paintings departments, and they just use either consultants or sort of fold them into these interiors auctions.
What about Chinese art? It's an area that over the last 20 years has had an awful lot of attention. Are there other less traditional than the Western heritage strains of art that you would suggest that people either continue to work in if they already are, or maybe take a look at?
Yeah. So contemporary Chinese paintings and contemporary Southeast Asian and Indian paintings, the market for those, we've definitely seen a huge resurgence in the past few years, specifically from the markets themselves in the country of origin, looking to repatriate those sort of artists. There's a wonderful Indian artist called by the name of Gaitonde, and his works have been commanding really strong seven-figure prices for the past couple years. And these are works that were painted in, the mid to late 60s.
Interesting. Okay, let's move off of fine arts in the interest of time. And we've covered diamonds. What about other jewelry, just jewelry in general? And if you did want to collect jewelry, would you go out and buy a brand new, beautiful sapphire or ruby with a nice setting? Or would you want to buy something that had established design lineage? How would you go about building such a collection?
Yeah. So if you're looking just from an investment purpose right now, signed jewelry. So designers such as Cartier, Van Cleef and Arpels, David Webb, Tiffany, any signed jewelry by those makers is commanding extremely strong prices, and they continue to rise. They will also always hold their value based on who the maker was, whether it's French or British or American. Gold also right now is something that is extremely high. So 1960s gold bangles have tripled in price pretty much over the past 15 years. The pearl market is sadly still extremely soft, just based on the influx of cultured pearls into the pearl market. Colored stones, rubies, emeralds, still holding their value. Within the diamond market, colored diamonds are presenting very differently than white diamonds. So colored stones are extremely desirable right now. If it's a blue diamond, a pink diamond, you may have just seen Buddy Melon's diamond just sold in Geneva for a great price. So, those sorts of stones are still holding their value, but I would say colored stones and signed jewelry by a known maker.
And are colored stones harder to lab grow? Is that something to do with it, or is that not even the case?
There are not as many lab grown sapphires, emeralds, rubies right now. The lab grown phenomenon has really been just focusing on the white diamond market. So the colored stones have been holding their value so far.
Okay, let's talk about coin collecting outside of the intrinsic value of the precious metal. Gold has obviously skyrocketed. If you're going to have a coin collection and gold has tripled in the last 2 or 3 years, one would think that your coin collection's done pretty well if it has a lot of gold in it. What about the inherent non-metal value of coins, and how do you put it together? And what do you think about on a go-forward basis? I mean, our thesis on gold is that gold typically is very spiky. We have very intense periods where it does very well, and then it sits for decades. And we're probably either in the middle or towards the end of one of those periods, in our view.
Clients have not been able to get enough gold coins to the market fast enough. If we look outside of that one specific area, like if we look at ancient Roman coins or other coins, almost next to nothing in terms of interest or investment rise over the past few years.
Interesting. Okay, so very specific type of coin, obviously here. Yeah.
Absolutely.
Okay, and I personally would question whether or not the metal is going to continue to do all that well. Therefore, I would question whether or not the coins are going to do well. So now let's move to wine. Wine is an area that has struggled tremendously because there's been, those younger generations, not just less wine relative to other alcohol, but less alcohol in general. Then the tariffs, I think, are causing a lot of disruption in terms of the free flow of goods. So wine, I would think, would be something that folks would want to stay away from on a go-forward basis. What do you think?
Wine is different than the other traditional collecting categories in that it is what we consider an experiential asset. It is also a consumable asset. So many people like to purchase it to enjoy it together, be parts of wine clubs. It allows access to certain lockers and wine societies that they wouldn't have access to otherwise. So it can be sort of a gateway into a community. From a purely investment standpoint, again, I think if you're buying these sort of cult wines, like if we look at California cult cabs, like a Screaming Eagle or a Harlan, those are all continuing to stay at the same top value that they were 5, 10 years ago.
What about French wines?
French wines have probably softened over the past sort of 5, 10 years. And of course, the auction market in London has had to switch and migrate all of their auctions over to Paris as part of the effects of Brexit. And so moving those to France, I think, has also affected the value.
Okay, let's think about other types of things to collect, the major categories, important categories that we've missed. I do think that for much of our male audience, let's say, not to be too gender biased here, but those men tend to be within the jewelry space. I want to give them their due for watches. They still like to spend some money in jewelry on watches. And you did mention that as a positive area, which is surprising to me because I would have thought the younger generations don't even know what a watch is. They've never had a watch on their wrist. They only know what a phone is. Talk to us a little bit about why watches might be in recovery a little bit.
Oh, yeah. The watch market is incredibly strong, and the collectors of watches are fanatics. So, again, these are markets that have largely shifted to online auctions. And we've seen the surge in prices of high-end brands, not just Rolex, but of course, some of the larger international brands. I think it was just a day or two ago, an FP Journe that belonged to Francis Ford Coppola sold for $10 million.
Wow.
Yes, it was incredible. That was at a New York auction. It was a prototype that Francis Ford Coppola worked on with Journe to create, and it commanded an incredible price, over 10. I think it was about almost $11 million for that single watch. But even outside of those really sort of rare market outliers, we're seeing the basic watch market bringing incredibly strong prices.
Okay, cool. We haven't talked about automobiles. Let's talk about automobiles a little bit. And that's certainly a category that many of our clients have passions for, not necessarily on the collectible level, but had they thought it was a rainbow to the pot of gold, maybe they would. So talk to us about automobiles, please.
The collector's car market has been extremely mixed over the past couple years. We've seen a huge surge in prices for supercars. So cars that have less than 10,000 miles or maybe never driven at all. But these are cars where, just nobody can go out and buy them. You basically need to be invited to purchase one of these supercars, be it a Lamborghini, McLaren, one of those. And so the only way that people can access these cars is at auction. And so to be part of that market and be able to obtain one of these supercars, we've seen prices fly at auction over the past couple of years. But the more sort of passion projects, the barn finds, the traditional sort of collector motor cars, the market for those has definitely softened over the past few years.
So I think we've covered most of the major categories. And I wanted to pivot to a different angle on collecting, which is, of course, that a lot of our clients have already accumulated collections. And they're looking to deaccession. They're looking to unwind over time. They can only drink another 1,000 or 2 bottles of wine. They can't drink the 80 to 100,000 they have stored, or whatever it may be. And they don't want to leave the kids the burden of dealing with all the stuff that they've accumulated. And so they need to figure out a strategy for unwinding these collections that they had so much passion for. And perhaps in many cases, it was not principally investment driven, but it has become a large part of the overall corpus of the family's assets. How would you recommend? It's going to be different, of course. Does everything go to auction, private sales? And even within the scope of the auction houses, I've always had this bias that Christie's has the most cachet. And if you're a seller, you go to Christie's because you're going to pay the same thing, unless it's really at the top of the market and someone's going to guarantee you more money at another house. You might as well go to Christie's if you're going to pay the same premium or fee to the seller. I know you may take umbrage to that because you're a Bonhams alumnus, but how do you think about, in general, strategies and among the auction houses? Would you agree that that's the way to go because they have the most cachet, really, or does it really matter?
It really depends on the category and, what the overall goals are. So, for example, there are some very esoteric categories like Native American and tribal arts. And Christie's historically has not had a department or specialists in that area. So you see a lot of wealthy collectors in the Pacific Northwest, in that sort of, California, Washington, Oregon area that have incredible Native American collections, from baskets to pots to totem poles, beaded war vests, you name it. And that's a category where the house with the most cachet would not make the most sense. Another important thing to look at, if we look at the category of fine art, if you've collected a number of works by the same artist, you might want to be careful. There might be a potential for a blockage discount there, in that you would not want to dump all of those on the market at the same time, as opposed to sort of parcel those out over the next couple years in order to keep the market high for that artist.
And at different houses as well, not just different times, right?
Absolutely. Different houses, different venues. So not all in New York. Maybe you put some in LA. But I would definitely do multiple venues, multiple auction houses, depending on what the category is. Another thing to look at is private sale. So many collectors and clients have a work of art that they would potentially want to sell, but they know that if it hits the market, everybody's going to know that that's their painting, sort of a beautiful trophy painting that's been hanging over their fireplace. And people start to wonder and ask questions. Are they having financial trouble? Were they forced to sell? Are they getting divorced? What's going on? So in those instances, people will often choose private sale. They don't have to wait for an auction. They have a little bit more control over the process and the pricing. And there isn't that sort of element of surprise and, of course, the very public aspect of the auction market.
And of course, auction houses now have been taking on dealers and entering the private sale space for a number of years. How do you feel about an auction house versus a dealer? Those that collect have relationships with dealers, but there almost seems to be something a little safer and more objective about working with an auction house to effect a private sale than a dealer. Dealers can often be a little bit more opaque in dealing with them, as opposed to an auction house to effect a private sale. But maybe I'm wrong. What do you think?
You're absolutely correct. Yes, much more opaque. I don't think that the dealer would potentially have the bandwidth of buyers that an international auction house would, right? The dealer has a limited platform compared to an auction house that has a very international platform and has a broader reach. I also think with dealers, it is more opaque. You don't necessarily know, what is the final price, what amount of premium is the buyer paying, what is their cut. So I think that's something, unless you've had a really long-standing relationship with the dealer, it wouldn't be my first choice.
Okay, terrific. Well, I would say that for clients, and I've collected myself a little bit and advised folks for many, many years, what I've always told folks is that unless it's an area that's not just a passion, but it's an area of expertise where you really feel that you know enough to be able to justify putting a meaningful amount of your wealth on the table, I probably wouldn't ever devote more than maybe 5% to these types of pursuits of an overall asset base. And it's one where, even within that parameter, really focus on what you love, what's going to bring you pleasure. I think that almost everything that you consume should be, I love the word you use, Victoria, experiential. If it's experiential and not consumable and durable, not ephemera, maybe even better. No disrespect to the onophiles listening, but I think that, keep it in proportion, at least as at the time of investment, to the overall asset base, and make sure it's something that brings pleasure and real passion. And I think that if those things happen and you develop an expertise, all the more likely that you will be successful from an investing standpoint as you develop your own sensibilities and knowledge. So that's how I would leave things for our listeners. And I'm going to give you the last word, Victoria, if there's anything that you'd want to add.
Yeah, I agree with that too. People are always asking me, what is the best investment I can make, in a work of fine art? And I always say, buy something that you want to hang on the wall and look at for the next 20 years, because that is really your best investment. But the final thing that I would want to say to any sort of, beneficiaries inheriting a collection, or people starting to help their parents or say grandparents with their estates, and as you said earlier, sort of deaccessioning works from a larger collection, is that the broader collectibles category has exploded over the past couple years. So things like fossils, dinosaur bones, sports memorabilia, any kind of Hollywood memorabilia, historic and rare documents, all of these things, before you just sort of toss it into a box and send it off to the Goodwill or something, it's important to really take a very close look at what those things are.
Well, that's a really interesting closing angle and great perspective for us. So thank you so much. This has been a great conversation. We'd love to have you on again in a period of time and see how things are developing for collectibles. And wanted to remind the audience in signing off today that for all of our thought leadership in the investing and planning space, please go to wilmingtontrust.com, and you'll also soon be able to read our 2026 capital market forecast entitled Economic Experimentation, Trade, Labor, and Debt Under the Microscope, which will give us a really interesting perspective on what we think 2026 will bring for us. So thank you, everybody, and thank you so much, Victoria.
Thanks, Tony. Take care.
This podcast is for educational purposes only and is not intended as an offer or solicitation for the sale of any financial product or service or recommendation or determination that any investment strategy is suitable for a specific investor. Investors should seek financial advice regarding the suitability of any investment strategy based on the investor's objectives, financial situation, and particular needs. The information on Wilmington Trust's capital considerations with Tony Roth has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. The opinions, estimates, and projections constitute the judgment of Wilmington Trust as of the date of this podcast and are subject to change without notice. The opinions of any guest on the Capital Considerations podcast who are not employed by Wilmington Trust or M&T Bank are their own and do not necessarily represent those of M&T Bank Corporate or any of its affiliates. Wilmington Trust is not authorized to and does not provide legal or tax advice. Our advice and recommendations provided to you is illustrative only and subject to the opinions and advice of your own attorney, tax advisor, or other professional advisor. Diversification does not ensure a profit or guarantee against a loss. There is no assurance that any investment strategy will be successful. Past performance cannot guarantee future results. Investing involves a risk, and you may incur a profit or a loss. Any reference to company names mentioned in the podcast should not be construed as investment advice or investment recommendations of those companies. Third-party trademarks and brands are the property of their respective owners. Third parties referenced herein are independent companies and are not affiliated with M&T Bank or Wilmington Trust. Listing them does not suggest a recommendation or endorsement by Wilmington Trust. Private market investments are only available to investors that meet the U.S. Securities and Exchange Commission's definition of qualified purchaser and accredited investor. Facts and views presented in this report have not been reviewed by and may not reflect information known to professionals in other business areas of Wilmington Trust or M&T Bank and may provide or seek to provide financial services to entities referred to in this report. M&T Bank and Wilmington Trust have established information barriers between their various business groups. As a result, M&T Bank and Wilmington Trust do not disclose certain client relationships or compensation received from such entities in their reports. Investment products are not insured by the FDIC or any other governmental agency, are not deposits of or other obligations of or guaranteed by Wilmington Trust, M&T Bank, or any other bank or entity, and are subject to risks including a possible loss of the principal amount invested. Wilmington Trust is a registered service mark used in connection with various fiduciary and non-fiduciary services offered by certain subsidiaries of M&T Bank Corporation, including, but not limited to, Manufacturers and Traders Trust Company, M&T Bank, Wilmington Trust Company, WTC, operating in Delaware only, Wilmington Trust N.A., WTNA, Wilmington Trust Investment Advisors, Inc., WTIA, Wilmington Funds Management Corporation, WFMC, Wilmington Trust Asset Management, LLC, WTAM, and Wilmington Trust Investment Management, LLC, WTIM. Such services include trustee, custodial, agency, investment management, and other services. International corporate and institutional services are offered through M&T Bank Corporation's international subsidiaries. Loans, credit cards, retail and business deposits, and other business and personal banking services and products are offered by M&T Bank, member FDIC. Copyright 2025, M&T Bank and its affiliates and subsidiaries. All rights reserved.